I just decided to start on a search for the best yielding dividend stocks with a solid track record of never lowering their payments. So today, I wanted to highlight a few of those firms that currently have yields of above 7% and have never lowered their dividends. It is important to remember that just because these companies haven't cut dividends in the past doesn't mean they won't do so again. Dividends are not an assurance to shareholders, and if a business is in a particularly awful situation, that results in a significant loss of income. The dividend is normally one of the first stuff to go. Make sure you do your own research and due diligence before investing in any of these companies, and come to your own conclusions. Some of these stocks have a higher level of confidence in me than others, and I believe the outlook for some of them is better than for the others on this list. But a consistent track record of never cutting your dividend speaks volumes about a company's strength. So, with that out of the way, let's get started looking at a couple of those stocks that have never had to decrease their dividend and currently yield over 7%. But first, please accept my warmest greetings if this is your first visit to our Smart Stocks Academy channel. To be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. So if you're ready, let's get to the video. Whitehorse Finance will be the first company we'll look at. Whitehorse Finance is a non-diversified, closed-end managed investment business development company focused on the origination of senior secured loans to privately held small-cap companies in a variety of industries. They invest in U.S. firms, usually between $5 and $25 million in companies with a market value of $50 to $350 million. This company has never lowered its quarterly dividend since its initial public offering in 2012. While they have been paying around 35 cents per share for over 8 years, there have been times recently when they've given a special dividend. These are similar to a bonus that a firm will pay in specific circumstances, such as if they had a very great quarter or if the board felt generous. Only around 2% of companies pay a special dividend, and they are difficult to foresee, so investors should not expect these kinds of additional dividend distributions in the future. Whitehorse Finance currently has a 9.56% dividend yield, and as I previously stated, they pay dividends quarterly. They are a business development company, or BDC, which is a type of specialist financing firm that invests in small and medium-sized enterprises, as well as distressed corporations in specific circumstances. When I'm analyzing a BDC, there are a few things I like to look at, so I'll go over a few of them here. The NAV, or net asset value, is a crucial number to remember. This can be found in the company's financial documents, where it is referred to as book value on the balance sheet. It is critical to ensure that the company's book value, which represents all of the asset it owns, is not declining. BDCs often trade around their NAV as well. Therefore, in the case of Whitehorse, we can see that their book value as of April 2022 is $15.10. This is beneficial since it shows that this company is now trading at a modest discount below its historical average. Another key factor to consider when evaluating a BDC is their loan portfolio. It is critical to ensure that the loans they provide cover a wide range of industries, as this helps with diversification. It also is important to note what type of loans they have in their portfolio. I prefer BDCs that hold virtually entirely senior secured debt, particularly with a high proportion of first lien debt. This is the safest type of debt, since first lien debt holders are first in line to be paid if the company they loaned money to goes bankrupt and they have to liquidate their assets to pay their debtors. However, first lien or any type of senior secured loan is not without any danger. It is possible that a firm will go bankrupt because it is so much in debt that it won't be able to repay all of its senior first lien creditors. However, a less well-funded business development firm may overinvest in preferred and common equity rather than senior secured debt. Whitehorse is lucky that in their whole loan portfolio is senior secured. Their industry diversity is also rather impressive. Healthcare services is their largest industry, accounting for 7.8% of their loan portfolio. And we can see that 47.6% of their portfolio is classed as other, indicating that their business isn't previously mentioned. I won't go into detail, but I like what I see with this company generally. I am not too familiar with it, but it appears to be a quality BDC. While its dividend isn't growing, if that is something you're looking for, it does appear to be a really solid BDC. I also noted that it is much smaller than other BDCs I've seen. In fact, according to what I could find, they rank 31st among the major business development businesses in this area. So they are not exactly big, but if you're looking for a 9.56% dividend yield, I think it is a stock worth looking into. The next stock, Altria Group, is one that I don't think any dividend investor is unfamiliar with. Altria produces and distributes cigarettes, oral tobacco products, and wine in the United States through its subsidiaries. Altria also owns a significant stake in Juul, an e-cigarette firm, and is the parent company of Philip Morris. Their stock currently yields 6.56%, and they pay quarterly dividends. They're also a dividend king, a select group of stocks that have increased their dividend year after year for more than 50 years. Furthermore, according to their website, between 2017 and 2021, Altria paid out over $29 billion in dividends to stockholders. They have also continued to boost their dividend at a faster rate than other dividend kings, increasing it by 5.47% over the last 3 years on an annualized basis. When it comes to Altria, investors have two primary concerns. The first issue is that people are concerned about its tobacco business, which has been under scrutiny for decades and is losing popularity globally. They've known for decades that smoking rates have been declining, and as a response, they have been working hard to improve their image. They've created a massive marketing effort around moving towards a smoke-free future, which involves developing alternatives that will encourage smokers to not just quit smoking, but also to quit smoking in a less damaging method than traditional cigarettes. The large amount of debt that Altria has taken on is another issue that investors have with the corporation. Altria had over $27 billion in debt as of the third quarter of 2021, according to their financials. This is more than double the debt from 2018, when they had approximately $11.89 billion in debt. When a firm takes on too much debt, the dividend is usually the first thing to go, but Altria still has several years before some of its long-term debt obligations must be satisfied. So far, it appears that Altria dividend is still viable for the time being. Their stock has been on the decrease for about 5 years, but it has been recovering after the 2020 pandemic collapse, indicating that investors are regaining confidence in this stock. The Goldman Sachs BDC is the next stop on our list. This is a BDC that focuses on private company investments in the middle market and mezzanine. They seek to increase their capital by originating secured debt, senior secured debt, junior secured debt, unsecured debt, and equities investments. The BDC of Goldman Sachs is looking to invest between $10 million and $75 million in companies with an annual EBITDA of $5 million to $75 million. I remember being astonished to find out that one of the world's major investment banks established its own business development organization a few years ago. BlackRock likewise has its own BDC, which was established in 2007. However, whereas BlackRock's BDC has been poorly managed, I believe Goldman's BDC is a very typical company in the sector. They presently offer 9.47% return to investors, which is very attractive, and they pay quarterly dividends. Goldman has always paid 45-cent dividend per share. Like Whitehorse Financial, it has given special dividends on a few rare occasions. 3 to be exact. Their portfolio is also quite impressive. According to their most recent investor presentation, senior secured debt made up 97.5% of their portfolio, with first lien assets accounting for 89.4%. One thing that has bothered me is that their NAV has been declining in recent years. Despite this, they have been able to maintain their dividend for the past several years, which speaks to the company's strength. And as I previously stated, I believe Goldman's BDC is adequate. Finally, PennantPark Floating Rate Capital is the last stock I'd like to cover. They also pay monthly dividends, which is a pleasant bonus. This is also a business development firm that looks to invest in secondary direct debt, equity, and loan opportunities. They seek to invest in private or thinly traded public middle market companies through floating rate loans, especially in the United States and to a lesser extent in other countries. The fund typically invests between $2 and $20 million in each company, as well as in equity assets such as preferred stock, common stock, warrants, and options. It does offer a very attractive 8.07% dividend yield with monthly payouts once again. Their portfolio is rather good because it is well diversified. They have 87% secured debt, which I usually like to see, but I see that there are a lot of media industries for some reason. I'm not clear as to why there are 3 different media sectors here, yet they account for 13.5% of their portfolio when combined. Despite having a slightly lower yield, I prefer it over Goldman's BDC since it pays monthly dividends. PennantPark might be worth examining if you're looking for a high-yielding monthly dividend investment. Always do your own research and due diligence before investing, and to diversify your portfolio to reduce the amount of risk you are exposed to. And that brings the video for today to an end. If you haven't already, hit the like button below to show your love and support for this video. Also, subscribe to the channel by clicking the subscribe button and turning on the notification bell right next to it to be the first to know when a new video is posted. Thank you for stopping by to watch, and we hope you had a great time. We hope to see you again soon.